Welcome back. Today we're jumping straight into an investment analysis report that makes a pretty bold contrarian case for PayPal, arguing that at $60, Wall Street is just plain wrong.
Okay, a strong contrarian take? I like it. Let's dig in and see how well the argument is built.
It's definitely built with conviction. The core idea is that the market is obsessing over, competition and slow growth, and it's completely missing the strengths hiding in plain sight. The whole thesis really stands on four main pillars, designed to show that PayPal isn't this struggling utility company that its multiple implies.
Got it. So what's the first one?
First up is the valuation disconnect. The material points out that PayPal is trading at a forward PE of around 12.
12? Wow.
Yeah, which is, that's roughly half of what you'd expect for a big, profitable tech company in the S&P 500.
Okay, so right off the bat, you're highlighting a massive gap between perception and reality. A 12 PE for a company with that kind of cash and user base is, well, it's pricing in zero growth, or worse.
Exactly. And building on that, the second pillar is what the analysis calls the yield shield.
The capital return story?
The capital return. Management is buying back a ton of stock. We're talking a projected $6 billion in 2025.
Which at a $56 billion market cap that's huge.
It's a staggering 10% buyback yield. Plus, they just started paying a dividend.
That is the ultimate defense for a thesis like this. It creates a hard floor under the stock price. It's really tough to argue for more downside when the company itself is such a huge buyer of its own shares.
It stabilizes things while the other parts of the story play out.
Right.
Which brings us to the third pillar, the hidden growth engines. This is where the report argues Wall Street is just completely blind.
Okay, the catalysts.
Yep. It cites the PayPal Ads Manager, the new AI and agentic commerce stuff through their OpenAI partnership, and the PYUSD stablecoin.
So this is the part that's supposed to make that 12 PE look ridiculous. If even one of those really takes off, the multiple has to re-rate.
It has to.
But is the report just listing them, or is it actually making the case for why they'll work and why the market is missing it?
We will definitely circle back to that because it's a key point. And finally, the fourth pillar is just the raw financial strength, the financial fortress.
The balance sheet.
$14.4 billion in cash on hand, $6 to $7 billion in projected free cash flow next year. You combine that with this feeling of peak fear in the market.
And the stock sitting on that $55 to $60 support level.
Exactly. It makes the case for a capitulation bottom.
Okay, so it's a very compelling, high-energy case based on all the internal strengths. But it also immediately brings up the first major issue for me.
Which is?
To really elevate the confidence in this contrarian position, the analysis report has to dedicate real, data-driven space to dismantling the established competitive threats.
I see. So the material does acknowledge the bear case. It explicitly names Apple Pay and slow growth as the culprits.
It does, but then it pivots.
It pivots right back inside to valuation and cash flow.
Exactly. And that's the weakness. It's focusing entirely on PayPal's intrinsic value without directly fighting back against the external forces that crushed the multiple in the first place.
So for someone who's already bearish on the stock, it feels like the report is dodging the main question.
It feels like an avoidance of the primary risk. The suggestion, then, is to integrate specific arguments that actively counter that bearish narrative about competition. The report has to show how PayPal's network or its new initiatives can neutralize something like Apple Pay.
So you're saying it needs to move beyond just PayPal is cheap and start proving PayPal is actively neutralizing the things that made it cheap.
That's the core of it. You have to fight the bear thesis on its own turf.
Okay, but is it realistic to expect the analysis to find granular head-to-head TPV data between PayPal and Apple? That's notoriously hard to get.
That's a fair challenge. And you're right. That data is often a black box. So if you can't get the quantitative data, you have to pivot to a powerful qualitative argument.
Okay.
Focus on the difference in utility for the merchant. That's where PayPal has the real edge.
And how do you frame that in a concrete way?
You use the Ads Manager as your proof point. The argument isn't about who processes the payment at checkout. Apple Pay is just a low-margin payment pipe.
Right.
The argument is that PayPal, with its Ads Manager, is moving into the high-margin data monetization business. It can offer merchants a service based on deep transactional data that Apple Pay literally cannot compete with.
So you're not fighting Apple Pay for checkout volume.
You're bypassing the competition entirely. You're arguing that PayPal is becoming an indispensable merchant services platform, not just a consumer wallet. That transforms the rebuttal from a defensive crouch into an offensive strategy.
I like that framing. It turns the competitive threat into a pillar of the thesis itself. So once that defense is built, we have to make the offense believable.
Exactly. Which brings me to my second point. The hidden growth engine section requires much greater structural weight and prioritization to solidify the thesis.
Right now, it just feels like a list. Ads Manager, AI, PYUSD, they're all presented as sort of equal bullet points.
And that's the weakness. It totally diminishes the impact. The reader is left thinking, okay, these are interesting ideas, but which one is actually going to move the needle, and when?
You have 3 potential game changers, but no roadmap.
No roadmap at all. So the suggestion for improvement is to prioritize them based on near-term revenue impact. You have to build a narrative that connects the dots from these new, high-margin businesses directly back to future free cash flow.
This is how you change that slow growth story.
This is the only way. You have to distinguish between what's going to make money next year versus what's a longer-term strategic option. And the PayPal Ads Manager has to be framed as the #1 leading catalyst.
Why that one specifically?
Because it has a proven, wildly successful analog that everyone understands. Amazon's advertising business.
Using that analog makes the upside feel measurable and much more credible.
It does. So, for a concrete example, the analysis needs to try and quantify the potential lift to the transaction margin, or the take rate.
Okay.
Even if the ads business achieves just a fraction of Amazon's success, what does that do? If it adds, say, 10 or 20 basis points to the overall take rate?
On their kind of volume, that's a massive impact to the bottom line. It flows right through to that 6 or 7 billion in FCF.
It's pure high-margin leverage. That gives the reader a real financial model to believe in, not just a concept. So you categorize the Ads Manager as the immediate 2026 driver. Then you frame AI and PYUSD as longer-term optionality that proves the platform's relevance. That clarity is what dismantles the slow growth narrative.
Excellent. So, we've rebutted the competition, we've prioritized the growth drivers. Now for the final piece, connecting today's $60 price to that massive upside the report is promising.
Yes, and that's the third and final critique. The analysis needs to establish a clear, modeled link between the current low valuation and the aggressive upside potential.
Right now, it does a great job of framing the stock as cheap. It's priced like a struggling utility at a 12x PE. That sets the floor.
It does, but then it calls it the easiest 2x trade. It's implying a price target of $120.
And that's the disconnect. Going from 60 to 120 requires either explosive growth tomorrow or
a massive PE multiple re-rating. And right now, that jump from a 12x company to, say, a 20x company is just a leap of faith for the reader.
The weakness is that you're left wondering, what specific event is going to make Wall Street suddenly change its mind and abandon that 12x multiple?
Exactly. What is the trigger? The suggestion, therefore, is all about financial modeling and clarity. The report needs to explicitly model the multiple expansion required to hit its price targets.
Define the milestones.
Define the specific criteria, the quarterly numbers, the margin expansion from ads, that will force the market to re-rate the stock from 12x back towards a more normal tech multiple of 20x.
Okay, so give us a concrete example of how to do that.
First, calculate what the PE multiple would be at an interim target, like the street high of, say, $105.
Right.
Then you state it plainly. To get to 105, the market needs to re-rate the multiple from 12x to 20x on current cash flow projections. That immediately makes the price target tangible.
It's not just a number anymore, it's a specific metric you're betting on.
And then, the crucial step, you tie that required multiple expansion directly to the success of the high-margin growth engines we just talked about.
So you're reinforcing that the growth isn't just about more low-margin payments.
It's about higher quality, margin-accretive growth from the ads business. The move from 12x to 20x isn't magic. It's what happens when the market finally understands the new profit trajectory. That turns a hopeful thesis into a quantified roadmap for the investment.
That's incredibly clear.